Today we're doing a complete breakdown of ASC 20520. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a company suddenly going bankrupt, blindsiding investors and creditors. ASC 205-20 changed the game by requiring management to assess and disclose any substantial doubt about the entity's ability to continue as a going concern. This section will help you understand the essentials of this critical standard and its impact on transparency. ASC 205-20 was introduced to solve a critical issue: the lack of disclosure regarding a company's potential financial distress. Management must now assess if there's substantial doubt about continuing as a going concern. This transparency helps prevent the shock of unexpected bankruptcies, protecting investors and creditors from unforeseen financial disasters. ASC 205-20 is mandatory for all entities under U.S. Generally Accepted Accounting Principles since December 2016. Management must regularly assess and disclose any substantial doubt about the company's ability to continue as a going concern. This requirement is crucial. It forces companies to proactively communicate potential financial distress, thus maintaining the trust and confidence of investors and creditors. The Going Concern Assessment Model is a vital tool under ASC 205-20. It compels management to scrutinize financial conditions that may jeopardize the entity's survival over the next year. By evaluating cash flows, debt, and other metrics, companies can identify potential threats early. This model is essential in interviews, showcasing your grasp of assessing a company's financial health and anticipating future challenges. Scope matters because many candidates overlook key exclusions, like entities in bankruptcy. That's a classic interview trap. Knowing whether ASC 205-20 applies to your entity is crucial for accurate financial reporting. Misapplying this standard can lead to significant misunderstandings in financial viability assessments. ASC 205-20 applies to all entities preparing financial statements in accordance with generally accepted accounting principles. This includes both public and private entities that must assess their ability to continue operations for at least 1 year. If there's substantial doubt about an entity's viability, disclosure is required to inform stakeholders of potential risks. ASC 205-20 does not apply to non-public entities not required to prepare generally accepted accounting principles financial statements. Interviewers love asking about entities in bankruptcy or liquidation, which are also excluded. These entities don't focus on future viability, as their financial reporting centers on closing operations. The going concern assumption means an entity expects to continue operations for at least 1 year beyond the balance sheet date. For example, if a company has a major contract expiring soon without renewal prospects, this could impact its going concern assessment. This assumption directly affects how assets and liabilities are valued and recognized. Substantial doubt occurs when there's significant concern about an entity's ability to continue as a going concern. For instance, persistent operating losses or negative cash flows can trigger this doubt. Management must evaluate if their plans can alleviate these concerns. If not, they're required to disclose the uncertainty to inform stakeholders. Edge cases often stump interviewees. Consider a company undergoing restructuring. Does ASC 205-20 apply? Or if a company is in pending merger talks, how does this standard affect its financials? What about a newly formed entity or foreign subsidiaries under U.S. parent companies? Understanding these scenarios helps navigate complex financial landscapes effectively. Imagine your business is on the brink. What now? The Going Concern Assessment Model provides clarity on survival odds and required disclosures. It's the backbone for determining if financial statements should be prepared under the assumption of continued operation. The Going Concern Assessment Model is designed to systematically address whether a company can meet its obligations. Our journey today follows Meridian Corporation, which secured a $10 million SaaS contract with Acme Incorporated. This model will guide us through evaluating their financial condition and more, providing a comprehensive view of their sustainability. First up, evaluating Meridian Corporation's financial condition is crucial. Their cash reserves seem stable, yet short-term liabilities loom large. A proper analysis means considering asset liquidity and liabilities side by side. Many overlook this balance, risking misjudgment. Here, the focus is on assessing these metrics at least a year ahead. Building on our evaluation, we now check if Meridian Corporation can meet their $8 million and $2 million commitments to Acme Incorporated. It's essential to weigh both short and long-term obligations. Many err by focusing solely on immediate debts, which paints an incomplete picture. Realistic projections are vital here, not just hopeful estimates. Analyzing Meridian Corporation's options, we consider renegotiating contract terms or securing extra financing. Mitigating factors can significantly alter outcomes, yet overconfidence in their effectiveness misleads many. ASC requires these strategies to be realistic and within the company's reach, ensuring they genuinely buffer financial strains. With all prior assessments in mind, we now decide if substantial doubt shadows Meridian Corporation's future. The inability to meet obligations by next quarter signals concern despite mitigation efforts. Many fail by not connecting financials with operational realities. Remember, ASC combines numeric data with qualitative insights to form misjudgment. We conclude with disclosure, making uncertainties visible. Meridian Corporation must clearly state concerns over their $10 million obligations, ensuring full transparency. This is where many slip. Underreporting misleads stakeholders and risks credibility. ASC mandates comprehensive disclosure, painting a full picture of the financial landscape and future challenges. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 205-220 guides how to accurately measure and disclose discontinued operations, ensuring stakeholders have clear, precise financial data. Every measurement impacts reported earnings, influencing investor perception and company valuation. For ASC 205-20, initial recognition of a discontinued operation is critical. Recognize it when a component is either held for sale, disposed, or abandoned. It's measured at the lower of carrying amount or fair value minus selling costs. An entity must recognize this in the period the component qualifies, ensuring timely and accurate financial reporting. Once a component is classified as held for sale, ASC 205-20 mandates ongoing remeasurement at each reporting date. Any significant changes in market conditions or alterations in disposal plans can trigger fair value adjustments. Impairment losses recognized when carrying amounts exceed fair value hit the income statement directly. Remember, assets under this classification aren't depreciated or amortized, maintaining their reported value until disposal. ASC 205-20 requires that discontinued operations be clearly presented as a separate line on the income statement. This comes after income from continuing operations, ensuring clarity. Any gains or losses related to the disposal are included here. On the balance sheet, assets and liabilities of the disposal group are separately listed, while notes provide crucial context, explaining the classification reasons and expected disposal timeline. Under ASC 205-20, disclosures play a pivotal role. You must disclose major asset and liability classes for transparency. Explaining the circumstances that led to the classification offers stakeholders clarity. Disclosing expected disposal timing helps in assessing potential financial impacts. Additionally, identify the segment previously reporting the discontinued operation, ensuring comprehensive understanding of segment impacts. Imagine a CFO managing a $10 million subsidiary sale, classified as held for sale under ASC 205-20. They measure the group at fair value, subtracting $1 million in selling costs. A subsequent $500,000 impairment loss reflects necessary fair value adjustments. The CFO ensures disclosures align perfectly with ASC guidelines, preserving transparency and accuracy, which ultimately influences investor confidence and market reactions. Understanding the hidden costs of discontinued operations is crucial for accurate financial reporting. ASC 205-20 provides the framework to isolate these figures, ensuring clarity for investors. By the end of this section, you will be able to calculate this from scratch in any interview. The formula helps distinguish earnings from continuing and discontinued operations, offering a clear view of a company's ongoing profitability. For instance, if a company earns $1.5 million from continuing operations and loses $200,000 from discontinued ones, its net income is $1.3 million, providing a transparent snapshot of financial health. Begin by identifying income from the ongoing parts of the business, such as $1 million. Next, find the income from discontinued operations. Here it's $150,000. Subtract the discontinued income, resulting in a net income of $850,000. This process ensures that the presentation of financial statements accurately reflects the core profitability of ongoing segments. Sometimes, discontinued operations involve extraordinary items, like a one-time gain from asset sales. Adjust the formula to include these items, accounting for tax impacts. For example, a $50,000 extraordinary gain might necessitate adjustments to reflect true net income. Accurate representation avoids misleading stakeholders about ongoing performance. Common errors can skew financial analysis, such as neglecting tax effects on discontinued operations, which might lead to an inaccurate net income presentation. Misclassifying operational segments further confuses financial health portrayals. Always ensure that extraordinary items are accurately included to prevent misrepresentation of core operational performance. For Meridian Corporation, start with $1.2 million from continuing operations. Subtract a $250,000 loss from discontinued operations. Then add a $100,000 extraordinary gain from asset sales. The final net income, $1.05 million, effectively separates ongoing profitability from non-recurring activities, providing stakeholders with a clear financial picture. Test your understanding with these scenarios. For the easy one, subtract $50,000 from $500,000 to find net income. In the medium scenario, adjust for a $20,000 gain, and for the hard one, factor a $50,000 tax adjustment into your net income calculation. These exercises reinforce your grasp of ASC 205-20. Every Big Four and investment bank interview on ASC 205-20 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. A going concern is an entity that's expected to continue its operations for the foreseeable future. Under ASC 205-20, it means no intention or need for liquidation. The logic is to assess if financial statements reflect this. A mistake is confusing it with liquidity issues. Remember, going concern focuses on operational viability, not immediate cash flows. ASC 205-20 exists to provide guidance on assessing a company's ability to continue as a going concern. It helps prevent misleading financial statements that might overlook foreseeable risks. A common error is considering it only in distress situations. Companies must evaluate their status at each reporting period to ensure accurate disclosures. A company records a going concern issue by disclosing substantial doubt about its continued existence. The disclosure must detail conditions, management's plans, and their impact. A common error is omitting management's response. The takeaway: always pair doubt with a strategy, clearly outlining how management intends to mitigate the concern. Going concern evaluates long-term operational viability, while liquidity assesses short-term cash needs. ASC 205-2020 requires assessing both, but they're distinct. Trap 1 is confusing the two. A going concern is about survival over time, not immediate cash flow issues. Always separate operational forecasts from liquidity calculations. Under Indian accounting standard, going concern evaluations are more principle-based, allowing judgment in disclosures. ASC 205-20 is specific, focusing on substantial doubt and management's plans. The trap is assuming they're identical. Note that Indian accounting standard may require less detailed disclosures depending on management's assessment of future conditions. If a company is no longer a going concern, it must revalue assets and liabilities at liquidation value. Assume a $10 million inventory, now worth $5 million. The error is ignoring revaluation. Memorize: liquidation requires revaluing all financial elements to reflect true recovery values, changing balance sheet dynamics significantly. A CFO must disclose conditions causing substantial doubt, management's plans and their potential success, include timelines and assumptions. Trap 2 is failing to identify relevant disclosures. Under ASC 205-20, every element must be transparent, focusing on both current conditions and strategic responses. Precision is key to clear communication. The time frame is 1 year from the issuance of financial statements. ASC 205-20 mandates this, ensuring future viability is considered. Trap 3 is overlooking this exact period. Always align evaluations with this time frame to meet compliance. It's crucial for accurate financial representation and stakeholder confidence. Liquidity isn't directly covered under ASC 205-20, which focuses on going concern status. The common mistake is assuming liquidity is a going concern aspect. Though related, liquidity addresses short-term cash flow, not operational longevity. Remember, ASC 205-20 is about assessing long-term viability beyond immediate cash situations. The objective of ASC 205-20 is to ensure entities assess their ability to continue as a going concern. This standard applies universally, requiring management to evaluate financial distress indicators and disclose any doubts. Key definitions include going concern, which implies ongoing operations. The assessment should cover a minimum of 12 months from the reporting date, ensuring financial statements present a fair view. Going concern assessment under ASC 205-20 involves evaluating conditions posing substantial doubt, requiring both qualitative and quantitative analysis. Management must gauge if plans can alleviate such doubt and disclose relevant conditions. This affects classification and measurement on financial statements, integrating into annual and ongoing assessments. Substantial doubt exists when it's probable the entity cannot meet obligations within a year. Understanding the key elements of ASC 205-20 is vital for interviews. Key traps include inadequate disclosure and underestimating financial distress, while ASC differs from international financial reporting standards by demanding explicit assessment and disclosure. Practical challenges such as predicting future cash flows and the risk of management bias are common. Clear and transparent disclosures are essential to maintain investor confidence and comply with regulatory expectations. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.